It's a Tuesday morning. You stop at a gas station on your way to work. You fill up the tank. Same station, same pump, same car. But the price on the screen is 40% higher than it was last month. You pay. You drive. You tell yourself it's temporary. By Friday, it's higher again. This isn't a thought experiment. This is already happening in parts of the world right now. And the trigger this time isn't a distant war from a history book. It's oil, it's the Strait of Hormuz, it's Iran. And the moment that strait closes, even for 2 weeks, the economic shockwave hits every supermarket, every mortgage payment, every savings account in the US, UK, and Canada simultaneously. Now here's the question nobody's asking, and the answer will genuinely shock you. The people who have gold right now, most of them will still lose. Not because gold is bad, not because gold doesn't work, but because of one specific mistake. A mistake so logical, so intuitive, so obvious that almost everyone makes it. You need to understand this before it matters. Here's what's actually building right now. This isn't speculation. This is economics with a lit fuse. 20% of the world's oil passes through the Strait of Hormuz every single day. The moment that flow gets disrupted, through conflict, blockade, or escalation, oil prices don't rise 10%, they spike violently, overnight. And oil isn't just fuel. Oil is food. Oil is medicine. Oil is everything on every shelf in every store you've ever walked into. When oil doubles, everything doubles, just on a slight delay. Layer on top of that, U.S. national debt at $39 trillion, the Fed trapped between inflation and recession, and foreign central banks quietly reducing dollar holdings. The conditions for a currency crisis aren't coming, they're assembling right now. And when governments get cornered by unpayable debt and a cracking economy, they always do the same thing. They print. First, it's stimulus, then emergency liquidity. The language stays calm, the math never does. Prices rise 5% a month, then 15%. Then people stop checking prices because the number changes before they reach the checkout. This is how hyperinflation starts, not with a bang, with a series of very reasonable-sounding decisions that compound into something civilization-altering. And right now, everyone is asking the same question. What do I hold when paper money dies? The answer everyone gives is gold, and that's exactly where the mistake begins. Here's what people think will happen when the next currency crisis hits. Smart people buy gold now. Gold holds its value. Smart people survive. Everyone else suffers. Clean, simple, logical. Here's what will actually happen. The moment a real hyperinflationary spiral kicks in, triggered by an oil shock, a dollar confidence crisis, or both simultaneously, most people holding gold won't be able to use it. Think about that for a second. You have a gold coin, maybe a 1-ounce American Eagle, worth, depending on the day, somewhere between $3,000 and $8,000 in a crisis scenario. You walk into a grocery store, you put it on the counter. The cashier looks at you like you've lost your mind. I can't make change for that. The denomination gap becomes your enemy. Gold is too valuable for small transactions and completely useless for daily survival purchases. It's like trying to buy a coffee with a $5,000 bill. Technically an asset, practically a paperweight when you're hungry. But it gets worse. When people do manage to exchange gold, when they find someone willing to trade, they are almost always on the losing end, because the person accepting gold knows exactly what it's worth. The person giving gold is desperate, and desperation is the worst negotiating position in any market, in any century, in any crisis. We're already seeing this in Turkey, Argentina, Nigeria. People with gold report the same pattern. Finding a buyer takes time, the exchange rate is punishing, and the window to act is always shorter than expected. In a fast-moving crisis, gold owners face a brutal paradox. Their asset is appreciating in value, while simultaneously becoming harder to liquidate at a fair price.
This is the gold trap. Gold is a store of value, a magnificent one, but in the acute phase of hyperinflation, the violent, chaotic, daily survival phase, what you need isn't a store of value. You need a medium of exchange, and those are two completely different things.
Let's continue with what actually works. So what actually protects people during the acute phase of a currency collapse? 3 things, and none of them are what the gold community is selling you. Number 1, foreign currency, specifically the dollar's replacement. Right now, the US dollar is still the world's reserve currency, but here's the uncomfortable truth. If the crisis originates inside the US economy, triggered by a debt spiral, a Fed policy failure, or a petrodollar shock from the Iran conflict, then the dollar itself becomes part of the problem. Smart money is already watching this. Swiss francs, Singapore dollars, commodity-backed currencies from nations with low debt and high resource exports. In a dollar stress scenario, these become what the dollar was to Weimar Germany, the lifeboat currency that lets you buy things while everyone else's money burns. The lesson isn't hold dollars. The lesson is always hold something that is more stable than your local currency, whatever that is at the time of the crisis. Number 2, real consumable goods. This sounds almost embarrassingly simple, but it is the most consistently documented survival strategy across every hyperinflationary episode in modern history. Food, energy, medicine, hygiene products, seeds, tools. These items don't just hold value during a currency collapse, they become the currency. When paper money loses meaning, people revert instantly to barter, and the person with a garage full of olive oil, canned goods, and propane is not a prepper. They are, functionally, a bank. In an oil shock-driven inflation scenario, exactly the kind the Iran conflict could trigger, oil costs cascade into food costs within weeks. The people who pre-purchased consumables at today's prices are effectively locking in an exchange rate that will look genius in 6 months. Number 3, speed. This is the one nobody talks about because it can't be packaged and sold. The single most important financial skill during hyperinflation isn't what you hold, it's how fast you move. When inflation is accelerating, cash is a melting ice cube. Every hour you hold it, it's worth less. The people who survive best are the ones who convert income into assets, any assets, as fast as humanly possible. Wages received on Friday should be converted by Friday afternoon, not invested, converted into goods, into stable currency, into anything with a slower decay rate than the paper in your hand. In a digital economy, this means having systems ready in advance, knowing exactly what you buy, where you'll buy it, and how fast you can execute before the crisis forces the decision under pressure. I'm not telling you to avoid gold. I'm telling you to understand when it works. Gold is not a crisis survival tool. Gold is a crisis recovery tool. During the acute chaos, the price spirals, the daily scramble, gold is illiquid and nearly impossible to use fairly. But after the reset, after the new monetary system stabilizes, the people holding gold walk into that new world with enormous purchasing power, buying land, businesses, and assets that the unprepared sold for fractions of their value during the crisis. This is the 5-year play, not the 5-week play. And here's what makes right now genuinely different. Central banks are buying gold at the fastest rate in 50 years. China, Poland, India, Turkey, Saudi Arabia. These are not retail investors following YouTube advice. These are the institutions that build the monetary system, and they are all making the same bet simultaneously. They are not preparing for today's inflation. They are positioning for after the next reset. The window doesn't stay open forever. 4 layers, simple, actionable. Layer 1, liquidity. 3 to 6 months of expenses in something spendable within 24 hours. In a fast crisis, speed of access beats everything. Layer 2, consumable buffer.
60 to 90 days of food, energy, medicine. A 40% price spike in 3 months means your pre-purchase supplies just returned 40% tax-free. Layer 3. Gold as anchor. Own it, but own it as a reconstruction asset, not a survival tool. Size it so it matters without killing your short-term liquidity. Layer 4. Knowledge. The people destroyed in every currency crisis weren't the poorest, they were the most uninformed. The highest return investment you can make right now is an accurate mental model of how crises actually unfold before the crisis makes that education expensive. The gold mistake isn't buying gold, it's buying gold and thinking that's the plan. Real resilience is a system: liquidity, consumables, long-term stores of value, and the understanding to deploy each at the right moment. The people who come out stronger aren't the ones with the most gold, they're the ones who understood the sequence. That isn't luck, that's preparation meeting understanding. Stay sharp, stay liquid, and never stop learning.